योगः कर्मसु कौशलम्.
Hello students, I welcome you all for the session of Application, Utility and Limitations of Break-Even Analysis. In the previous session, we have covered the concept of CVP analysis, assumptions, contribution and break-even point. In this session, we will focus on utility of break-even analysis, its limitations, types of break-even and break-even analysis applications. The earlier discussions makes it clear that break-even analysis is based on unrealistic assumptions like one of the important assumptions states that there would not be any change in fixed cost up to a certain production level. In spite of some unrealistic assumptions, its usefulness has to be accepted and we have to acknowledge the fact that it has huge application. Objectives of this session: to understand the utility and limitations of break-even analysis, to understand break-even applications in determining sales to produce desired profits, additional sales volume to offset a reduction in selling price and so on, to understand cash break-even point, composite break-even point and financial break-even point and its computation, to know which factors affect the profits and how changes can affect the break-even sales. Importance of break-even analysis: it depicts the cost behavior and the relationship of cost, volume and profit, which helps in taking various important decisions. The break-even analysis helps the management in bringing solutions to problems like to find out the sales required to earn the profit necessary for reasonable return on investment, to decide the amount to be transferred to the reserve and then paying reasonable dividend on preference and equity shares, to determine the selling price so that to reach a desired level of break-even point and that of profits, ascertaining the cost and revenues at different levels of production. Estimation of variable cost per unit of output is also made possible with this analysis. It enables the management to plan for the optimum utilization of capacity. It helps management to take decisions relating to change in sales mix and do inter-firm comparison of profitability. Break-even analysis is used to calculate the point at which a specific measurement of revenues is equal to a specific measurement of cost. In cases where revenues are higher than cost, the business is profitable and desirable, whereas where costs are higher than revenues, the business is unprofitable and thus undesirable. In general, the higher the break-even point calculated, the riskier the business is estimated to be. The break-even analysis provides answers to important questions like what profit will result from an X% increase in sales volume, what would be the effect on operating profits if there is increase in fixed cost, and so on. Types of break-even point. In the last session, a simple type of break-even point based on cost and revenue, that is the profit and loss break-even in respect of sales, has been explained. In this session, we will discuss the other types of break-even, and they are cash break-even, composite break-even and financial break-even. The cash break-even point. Cash flow break-even point is the point at which the cash inflow will be just equal to the cash required to meet cash payments. A company requires money for acquiring capital assets and to meet working capital requirements. These requirements can be partly met by its own funds and partly by loans and advances from financial institutions. The industry requires term loans to acquire capital assets like land and building, plant and machinery. Here, it is essential to find out that whether the company will be able to meet its obligations relating to interest and principal payments. It will be more interested in knowing the level of break-even point where not only total costs are required but also the full debt service. The level of break-even is called the cash break-even. It is based on revenue and cost data involving cash flows. The non-cash items need not be considered. In case of depreciation, writing off the preliminary expenses, no cash actually goes out, but they are shown in the debit side of the P&L account, which results into reduction of profits. Such non-cash expenses are not to be taken while estimating cash flow break-even point. Cash break-even point is calculated using the given formula. Cash outflow due to fixed expenses to be divided by contribution per unit. Let's understand this with the help of an example. For a firm, the fixed expenses are salaries of indirect workers rupees 80,000, rent rupees 50,000, insurance rupees 10,000, depreciation rupees 40,000, total fixed cost rupees 1,80,000. The data shows that the company pays rupees 1,80,000 towards fixed cost, but this is not true as depreciation is a non-cash expense and no cash actually goes out of the firm, but it is deducted from profits, because of which the amount of profits gets reduced and the tax liability falling on it also gets reduced. Depreciation provides the tax shield. Suppose the rate of tax is 50%. The tax saving on depreciation would be rupees 20,000, that is 40,000 to be multiplied by 50%. Thus, if the tax shield is taken into account, it would appear like this: fixed expenses except depreciation rupees 1,40,000, that is total fixed cost minus depreciation, that is 1,80,000 minus 40,000. Less savings in tax due to depreciation rupees 20,000, that is depreciation into the tax rate. So, cash outflow due to fixed expenses after the tax effect is rupees 1,20,000. If the selling price is assumed to be rupees 20 and its variable cost is rupees 12, the contribution per unit would be rupees 8. Therefore, cash flow break-even point would be equal to rupees 1,20,000 divided by contribution per unit, that is rupees 8. So, rupees 1,20,000 divided by 8 will give you a cash break-even point of 15,000 units. So, if the production of the company is limited to 15,000 units, then there will be no profit earned by the company and it will not be required to pay tax, and the tax shield due to depreciation would not be available. Hence, the real method of computing cash break-even point is to ignore tax savings due to depreciation. In that case, the real cash break-even point would be 1,40,000 to be divided by rupees 8, which is equal to 17,500 units, that is total fixed cost minus depreciation to be divided by contribution. Let's take one more example to understand the concept better. Sales rupees 40,000, selling price rupees 50 per unit, fixed cost including rupees 4,000 depreciation rupees 28,000, variable cost per unit rupees 20. Fixed cost without depreciation is rupees 24,000, that is rupees 28,000 minus rupees 4,000. Contribution is equal to selling price minus variable cost, which is equal to rupees 50 minus rupees 20, which is equal to 30. So, cash break-even point is equal to cash fixed cost divided by contribution per unit. Therefore, rupees 24,000 divided by 30 will give you the cash break-even point of 800 units. Financial break-even point. It is a point defining the level before the EBIT, earnings before interest and tax, at which the earnings per share of the company is equal to 0. In other words, it is the level of EBIT that equals the fixed financial cost for the company, such as interest on the debt, preference dividend, and more. It is the minimum EBIT that a company should earn to meet its fixed commitments. Anything that a company earns beyond this level or point is the profit to the shareholders. The degree of financial risk would increase if the financial break-even point increases. For calculating a financial break-even point, it is necessary to include interest expense and dividend on preference shares. Since preference dividends is not tax deductible, we must divide the total dividends by 1 minus the tax rate in order to obtain the EBIT necessary to cover these dividends as a financial charge. Financial break-even point can be defined as the level of EBIT which is equal to firm's fixed financial cost. Financial break-even point attempts to find EBIT that results in zero net income. The formula for financial break-even point is equal to I plus dP upon 1 minus T, where I is equal to annual interest charges, dP is preference dividend, and T is tax rate. Let's understand this important concept with numerical example. Company ABC has rupees 200 million preferred stock at 5% per annum. The company incurs a total interest expense of rupees 20 million and earns an interest income of rupees 2 million. Tax rate is at 33%. What would be the financial break-even point for company ABC? First step would be to calculate the earnings before taxes, preferred dividend payments, taxes, and interest expenses. Preferred dividends is equal to 200 million into 5%, which is equal to rupees 10 million. Net interest expense is equal to rupees 20 million minus rupees 2 million, which is equal to rupees 18 million. Now that we have all the metrics to calculate the financial break-even point, let's see the final calculation. Financial break-even point is equal to preferred dividends upon 1 minus tax rate plus net interest expenses, which is equal to rupees 10 million to be divided by 1 minus 33% plus rupees 18 million, which will give you rupees 32.92 million. Let's consider another example to make things clearer. Company ABC has come up with 3 financing plans to fund its new project. Plan 1, rupees 1,50,000 equity. Plan 2, rupees 1 lakh in equity and rupees 50,000 in 8% debentures. Plan 3, rupees 75,000 in equity, rupees 25,000 in 8% debentures and rupees 50,000 in 10% preference share capital. Calculate the financial break-even for each option assuming a 50% tax rate. For Plan 1, the break-even point is 0 as there is no interest expenses and preference dividend. In the Plan 2, the financial break-even level will be equal to rupees 50,000 into 8%, which is equal to rupees 4,000. In this case, there are only interest expenses and no preference dividend. For the Plan 3, the financial break-even point will be equal to 10% of rupees 50,000 to be divided by 1 minus T, that is 50%, plus 8% on rupees 25,000, which would be equal to rupees 10,000 plus rupees 2,000, which will give you rupees 12,000. It is clear from the second example that the financial break-even point increases as the company takes on more debt. Composite break-even point. So far, we have dealt with break-even point of firms producing single product. We can also calculate the composite break-even point for a firm producing multiple products. Composite break-even point in sales value is equal to total fixed cost to be divided by composite PV ratio, and composite PV ratio is equal to total contribution to be divided by total sales into 100. Let's take one numerical example to understand this concept. From the information of a company producing 3 products, you are required to compute composite PV ratio and composite break-even point. Product X sales revenue is rupees 20,000 and variable cost is rupees 10,000. Product Y sales revenue is rupees 40,000 and variable cost is rupees 14,000. Product Z sales revenue is rupees 60,000 and variable cost is rupees 36,000. Fixed cost is rupees 50,000. Let's solve this. Using these formulas, composite break-even point in sales value is equal to total fixed cost to be divided by composite PV ratio, which is equal to 50,000 to be divided by 50%, which will give you rupees 1 lakh. Composite PV ratio is equal to total contribution upon total sales into 100, which is equal to contribution for products X is 10,000, Y it is 26,000 and Z 24,000. Therefore, total contribution is equal to 60,000. The total sales revenue is 20,000 plus 40,000 plus 60,000, which is equal to 1,20,000. So, 60,000 to be divided by 1,20,000, which will give you 50%. Break-even analysis applications. The application of break-even analysis is very wide and helps in taking various decisions like sales volume required to produce desired operating profit, effect on operating profit of a given change in sales volume, additional sales volume required to offset a reduction in selling price, effect of changes in fixed cost, effect of changes in variable cost, effect of multiple changes, etc. The break-even analysis studies the fixed and variable cost behavior and thereby studies the effect of decisions upon cost and sales. Sales volume required to produce desired operating profit. One application of a break-even analysis is to determine the required sales volume to generate a budgeted amount of profit. The required sales is determined with the help of equation fixed expenses plus desired operating profit to be divided by PV ratio. Let's understand this with the help of an example. Pinky Limited, a multi-product company, furnishes the data relating to the current year. Sales for the first half year is rupees 4,50,000 and for the second half it is 5 lakhs. The total cost for the first half is 4 lakhs and for the second half it is 4,30,000. Assuming that there is no change in prices and variable cost and that the fixed expenses are incurred equally in the two half periods, calculate for the year the profit volume ratio, fixed expenses, break-even sales. If the desired operating profit of Pinky Limited is rupees 1,40,000, then find the required sales volume. Let's solve this. We all know that sales revenue minus total cost would give you net profits. So, rupees 4,50,000 minus 4 lakh will give you 50,000 in the first half. Rupees 5 lakh minus 4,30,000 is equal to 70,000 in the second half. On a differential basis, change in sales revenue rupees 50,000 and change in cost is 30,000. Therefore, change in total profit is rupees 20,000. We know that only variable cost changes with a change in sales volume, and hence change in total cost is equivalent to variable cost rupees 30,000. Accordingly, the additional sales of rupees 50,000 has earned a contribution margin of rupees 20,000. Rupees 50,000 sales minus rupees 30,000 variable cost. PV ratio is equal to rupees 20,000 upon rupees 50,000, which will give you 40%. VV ratio is equal to 100% minus 40%, which will give you 60%. Accordingly, 60% of the total cost are made up of variable cost and the balance represents the total fixed cost. Total sales revenue for first and second half is equal to fixed cost plus variable cost plus net profit. Rupees 9,50,000 is equal to fixed cost plus 60% of 9,50,000 plus rupees 1,20,000, that is total profit for first and second half. So 9,50,000 is equal to fixed cost plus rupees 5,70,000 plus rupees 1,20,000. 9,50,000 minus 6,90,000 will be equal to fixed cost. So, fixed cost is 2,60,000. BEP in amount will be equal to rupees 2,60,000 to be divided by 0.40 will give you 6,50,000. So, if the desired operating profit of Pinking Limited is rupees 1,40,000, then the required sales would be determined using the equation fixed expenses plus desired operating profits to be divided by PV ratio. So, rupees 2,60,000 plus rupees 1,40,000 to be divided by 0.40, that is PV ratio, will give you rupees 10 lakhs. Now, let's understand effect on operating profit of a given increase in sales volume. It can be calculated using equation budgeted sales revenue minus break-even sales revenue to be multiplied by PV ratio. Suppose that Pinky Limited forecasts 10% increase in sales next year. The projected sales would be rupees 9,50,000 plus 10%, which will give you 10,45,000. The projected profit will be 10,45,000 minus 6,50,000 to be multiplied by 0.40, which is equal to rupees 1,58,000. Additional sales volume required to offset a reduction in selling price. The sales manager, on the basis of a market research, may report to the management that due to increased competition in the market and the liberal import policy of the government, the present price is relatively higher. So, reduction in price is suggested to remain competitive. Suppose that Pinky Limited reduces its selling price from rupees 10 per unit to rupees 9. The sales volume needed to offset reduced selling price, and in order to maintain the existing operating profit of rupees 1,20,000, the equation would be desired profit plus fixed expenses to be divided by revised PV ratio, which would be equal to rupees 3 to be divided by rupees 9. So, 1,20,000 plus rupees 2,60,000 divided by 0.33, which is going to give you 11,40,000. The required sales volume of rupees 11,40,000 represents an increase of about 20% over the present level. On the other hand, if the firm has the opportunity to increase the unit selling price of the product, the impact of increased sales price would be that the BEP will be reached earlier because an increase in the selling price will raise the contribution margin, assuming no change in the variable cost. An increased contribution margin will decrease the sales volume necessary to reach a desired goal. Assume that the management of Pinky Limited increases the selling price of its product from rupees 10 to rupees 12. The desired sales volume would be fixed cost plus profits to be divided by revised PV ratio, which is equal to 2,60,000 plus 1,20,000 to be divided by revised PV ratio, that is 0.50, which you obtain by dividing 6 by 12, which will give you rupees 7,60,000. Now let's understand effect of changes in fixed cost. A firm may have to deal with the situation of increasing fixed cost. An increase in the total budgeted fixed cost of a firm may be necessitated either by external factors such as an increase in property taxes, insurance rates, factory rent, and so on, or by a managerial decision of an increase in salaries of executives, expansion of the present plant capacity so as to meet the additional demand. The increase in the requirements of fixed cost would imply the computation of relative break-even points, required sales volume to earn the present profits. The effect of the increased fixed cost will be to raise the BEP of the firm. Assume the management of Pinky Limited decides a major expansion program of its existing production capacity. It would lead to incurring of extra fixed cost of rupees 80,000 on advertisement to increase the sales volume and another rupees 1,60,000 on account of new plant facility. The relative break-even points will be present facilities is equal to fixed cost to be divided by PV ratio, which would be equal to rupees 2,60,000 divided by 0.40, which will give you 6,50,000. Proposed facilities will be equal to present FCs plus additional FCs to be divided by PV ratio. So, rupees 2,60,000 plus 2,40,000 to be divided by 0.40, which will give you rupees 12,50,000. It may be noted that increase in fixed cost from rupees 2,60,000 to rupees 5 lakh has caused increase in the break-even point from rupees 6,50,000 to rupees 12,50,000. The required sales volume to earn the present profits, present fixed cost plus additional fixed cost plus present profits to be divided by PV ratio, which is equal to rupees 2,60,000 plus rupees 2,40,000 plus 1,20,000 to be divided by 0.40, which is equal to 15,50,000. These computations may be reported in a summarized tabular form. Fixed cost for present facilities is rupees 2,60,000 and prospective facilities it is rupees 5 lakhs. This shows an increase of rupees 2,40,000. BEP sales volume is rupees 6,50,000 for present facilities and rupees 12,50,000 for prospective facilities. This shows an increase of rupees 6 lakhs. BEP sales volume in units for present facilities is 65,000 units and prospective facilities 1,25,000 units, which shows an increase of 60,000 units. Sales volume to earn existing profits for present facilities rupees 9,50,000 and prospective facilities 15,50,000, which is an increase of 6 lakhs. Sales volume in units to earn existing profits in present facilities 95,000, which increases to 1,55,000, that is an increase of 60,000. Effect of changes in variable cost. Assuming an increase of variable cost by rupees 1 per unit for Pinky Limited, the new contribution margin would be rupees 3, that is rupees 10 minus rupees 7, and the revised PV ratio will be equal to 0.30, that is rupees 3 to be divided by rupees 10. Revised break-even point would be equal to rupees 2,60,000 to be divided by 0.30, which will give you rupees 8,66,666.66. Desired sales volume to earn existing profit is equal to rupees 3,80,000 to be divided by 0.30, which will give you rupees 12,66,666.66, is calculated using the equation fixed cost plus existing profit to be divided by revised PV ratio. 3,80,000 is the summation of fixed cost rupees 2,60,000 and operating profit rupees 1,20,000. Assuming that variable cost of Pinky Limited declines by rupees 1 per unit, then revised break-even point will be equal to rupees 2,60,000 divided by 0.50, which will give you rupees 5,20,000. Here, the PV ratio has changed as variable cost has changed. So, selling price minus variable cost is equal to 10 minus 5, which is equal to 5 upon 10, which is equal to 0.50. Desired sales volume to maintain existing profits will be equal to rupees 3,80,000 to be divided by 0.50, which is equal to rupees 7,60,000. Now let's understand effect of multiple changes. So far we have learned that if there is a change taking place in one of the three variables affecting profits, cost, price and sales volume, then how the impact would be calculated, but where more than one factor is affected, the break-even point analysis can be applied as shown here. Fixed cost new plus desired net income to be divided by 1 minus tax rate, this whole to be divided by contribution margin per unit, which will be calculated from new selling price minus new VC to be divided by new selling price. Assuming the given set of new figures for Pinky Limited, selling price has increased from rupees 10 to rupees 11. Fixed cost has increased from rupees 2,60,000 to rupees 4 lakh. Variable cost per unit has reduced from rupees 6 to rupees 5.50. Contribution margin per unit has increased from rupees 4 per unit to rupees 5 rupees 50 per unit. Desired net income after taxes has increased from rupees 1,20,000 to rupees 2,50,000. Tax rate is 35%. Let's solve this where incorporation of changes in more than one variable. Desired sales volume on the basis of new data. Substituting in the equation rupees 2,60,000 plus rupees 1,40,000 plus 2,50,000 to be divided by 0.65 divided by 0.50. 0.50 is obtained by rupees 5.5, that is contribution margin per unit to be divided by new selling price, that is 11, which will give you 7,84,615.38 to be divided by 0.50. So, you get 15,69,230.769. Desired sales volume on the basis of existing data will be equal to rupees 2,60,000 plus rupees 1,20,000 to be divided by 0.65. This all would be divided by 0.40, which is obtained by rupees 4 to be divided by 10, which will give you rupees 4,44,615.38 to be divided by 0.40, which is equal to 11,11,538.46. VCP, volume cost profit analysis, and a segment of the business. The fundamental approach of applying the VCP analysis to a segment of the business is same as the applying to the business as a whole. The VCP approach may be applied to problems related to individual product lines, territories, methods of sale, channels of distribution, or any particular segment of the business. In all these conditions, fixed cost and PV ratio are required. Let's take an example. Pinky Limited has 4 sales divisions. The relevant data for its southern division is reproduced below. Direct fixed cost is rupees 1 lakh, PV ratio is 0.40. Allocated fixed cost from head office rupees 50,000. The sales volume required to cover direct expenses would be direct fixed cost divided by PV ratio, which is equal to 1 lakh divided by 0.40, which would come to rupees 2,50,000. the total sales volume required to cover all fixed cost would be higher as shown by equation direct fixed cost plus allocated fixed cost upon PV ratio, which is equal to rupees 1 lakh plus rupees 50,000 to be divided by 0.40, which will give you 3,75,000. Now let's understand multi-product firm sales mix. So far, we have confined our discussions to a one product company. However, many manufacturers make more than one type of product. The relative proportion of each product sold in the aggregate sales is termed as the sales mix. A change in the mix of products sold usually affects the weighted average PV ratio and consequently the BEP. Thus, when the products have different PV ratios, changes in the sales mix, product mix will affect the BEP and the results from operations. From the information given in the form of income statement for the first quarter ending March 31st, sales for PQR is given as 10 lakhs, 6 lakhs and 4 lakhs, so total sales is 20 lakhs. Variable cost for PQR is 8 lakhs, 4 lakh 20,000 and 2 lakh 40,000, so the total is 14 lakh 60,000. Contribution for PQR is 2 lakh, 1 lakh 80,000 and rupees 1 lakh 60,000. The total contribution for all the products is amounting to rupees 5 lakh 40,000. Fixed cost is 2 lakh 70,000. Net income is also 2 lakh 70,000. PV ratio for PQR is 0.20, 0.30 and 0.40. The overall PV ratio is 0.27. Break-even sales is rupees 10 lakhs. Sales mix percent is 0.50, 0.30 and 0.20 for P, Q and R. If rupees 4 lakh of the sales shown for product P could be shifted equally to products Q and R, the profit and the BEP would change as shown. Sales would increase for Q and R by 2 lakhs each, that is for Q 8 lakhs and for R 6 lakh, and for P it would be rupees 6 lakhs. The variable cost would be in proportion to sales. For example, when sales is 10 lakhs, the variable cost is 8 lakhs. So, when sales for P is 6 lakhs, the variable cost is 4 lakh 80,000. In the same way, for Q and R would be calculated. The total variable cost for P, Q and R would be rupees 14 lakhs. The contribution for PQR is 1 lakh 20,000, 2 lakh 40,000 and R also 2 lakh 40,000. The total contribution is 6 lakhs less fixed cost rupees 2 lakh 70,000. Net income, that is contribution minus fixed cost, is 3 lakhs 30,000. PV ratio is equal to contribution upon sales. So, for PQ and R, the PV ratio is 0.20, 0.30 and 0.40 and overall it is 0.30. Break-even sales is equal to fixed cost to be divided by PV ratio, which is equal to 2,70,000 to be divided by 0.30 will give you 9 lakhs. Sales mix percent for PQR are 0.30, 0.40 and 0.30. Sales mix percentage is calculated by dividing the sales of P, that is 6 lakhs, by total sales multiplied by 100. What we understood from this information? The rupees 4 lakh sales has been shifted from P, so from 10 lakhs it is now 6 lakhs, and since it is divided equally between Q and R, so the sales for Q increases from 6 lakh to 8 lakhs and R from 4 lakhs to 6 lakhs. The variable cost will be for the new level of sales and it would decrease proportionately for P and increase proportionately for Q and R. Contribution is the difference between sales and variable cost. PV ratio is equal to contribution to be divided by sales. Break-even sales is obtained by dividing the fixed cost by PV ratio. Sales mix percentage is calculated by dividing the sales of P, that is 6 lakhs, by total sales to be multiplied by 100. This example shows that by increasing the mix of high PV products Q from 30 to 40%, R from 20 to 30% and decreasing the mix of a low PV product P from 50 to 30%, the company can increase its overall profitability. In fact, it can further increase its total profits if it can manufacture and the market can absorb more quantities of Q and R, say rupees 10 lakhs each. Since Q and R are giving more contribution, now we are having sales of 10 lakhs each for Q and R. The variable cost is 7 and 6 lakhs for Q and R, so the contribution for Q and R is 3 lakhs and 4 lakhs respectively, making total contribution equal to 7 lakhs. From total contribution, fixed cost of rupees 2,70,000 is deducted to get a net income of rupees 4,30,000. The PV ratio is 0.30, 0.40 and 0.35 for QR and the total. Break-even sales are 7,71,428.57. From the table, it can be deduced that other things being equal, management should stress upon products with higher contribution margins. For individual product line income statements, fixed costs should not be allocated or apportioned. Now let's see what are the limitations of break-even analysis. Break-even analysis is based on certain unrealistic assumptions like in break-even analysis, cost can be classified into fixed and variable categories. In practice, it is very difficult to have such a clear-cut demarcation between fixed and variable cost. The analysis assumes that fixed cost remains constant. However, in reality, it may change. Variable cost may not always vary directly proportionately to the volume. The selling price remains constant is not a valid assumption. This analysis does not consider capital employed in business. It presents only one fact of profit planning. It is static in nature. So let's summarize what we have learned. Profit planning is a function of coordinating the selling price of a unit of product, the variable cost per unit of making and selling the product, the volume of sales, sales mix in the case of multiple product firms, and the total fixed cost. A most popular and widely used tool to study this analysis is break-even analysis. It has a huge application in decisions like sales volume required to produce desired profits, operating profit at a given level of sales volume, effect on operating profits of a given percentage change in sales, effect of changes in fixed cost, and so on. Though the application of break-even analysis is vast and enormous, it suffers from some serious limitations. I hope you enjoyed the session. Thank you all.